Hello and welcome to the Papaya Academy. I'm Einat Gez and I'm joined today by Efrat Laor from JP Morgan Bank. Together, we'll discuss the evolving world of cross-border payments and talk a little bit about the ins and outs of workforce and B2B payments, which are crucial for all businesses that operate cross-borders to get right. Hi, Efrat. Thanks for joining us today.
Thanks for having me. I'm really happy to be here.
So, Efrat, tell us a little bit about the movement of money cross borders and the traditional roles of the banking systems here.
We want the world to have coverage of payments from every country to every country. But not every bank is located in every country. So the correspondent banking system is a network that allows banks to move funds from one to another until they arrive to the final beneficiary. They do this both by the correspondent banking framework, but also through the SWIFT messaging system. We're talking about banks that need to be compliant with regulation in each country. And this network, although it is very reliable, it is also quite complex.
So I'll tell you what I hear here. I hear that from one hand, banks can really kind of collaborate with every bank around the world and send funds on behalf of their clients. But from the other hand, there is kind of a chain here that probably takes a bit of time, and there is a compliance banks by banks that they need to comply with. Can you tell us a bit about those challenges?
We're talking about a network of banks, and they're moving money from the first to the second to the third. And because each bank carries the responsibility on its own, each and every one of them want to make sure that what they're doing is fully compliant. These processes and these interventions, they're manual interventions that take time. Also, these are called high-value payments. There are fees being deducted from each and every payment. So when you send a SWIFT, you don't always know exactly what is the amount that will be received by the other side. There are also cross-border regulation and cross-border and FX regulation. So if you're sending money to a country that has controls over their FX, you might need to provide documents.
So from one hand, we are all living in a world of immediate transactions, right? Emails, Venmo, PayPal. But from the other hand, on the global workforce side, it's kind of a lot of unknown, right? I know when I'm sending the funds. I don't know when they're going to arrive. I don't know the amount that exactly is going to hit the bank account. And I also don't have the certainty that it will not come back or be delayed in some place for further information and questions.
There is a lot of friction. We're trying to balance between efficiency and something which is seamless, but also the safeguarding of funds and the safeguarding of compliance and making sure that the world is doing the right things and avoiding money laundering.
So that friction can be really problematic when you're managing workforce payment. Because again, 50 years ago when SWIFT started, you had quite few people that would be employed outside of their country. So global workforce is relatively new. And as you said, compliance, regulation, the difficulties of even opening a bank account in every country, right, are creating two different motions.
I think you're very right. The world of workforce, us as employees, we want to receive our funds on the day where they're supposed to be received. And we want them to be received in our bank and to be known that it is a payroll payment, right? Because that has an impact on my ability to get loans or pay my mortgage. So obviously, that is a very specialized payment. The banking sector is trying to do it better and better.
So on a perfect world, fintech can create a really, really good client infrastructures. We are creating layers of embedded finance, quite a lot of things in order to allow fintech within global kind of organizations. But how do you strike this balance between great client experience, easiness, speed, to compliance, to being heavily regulated?
The balance is between seamless, fast, easy, accessible, and I'd say also responsible. If one fintech uses another fintech, which uses another fintech, then eventually you're bringing in more risk than if one fintech uses a very large bank. On one hand, the client journey there could be impacted because those processes are actually paving the way for the entire system. And the client is thinking, first of all, about safeguarding of funds. Where are my funds held? Are they held with a large bank? Are they held with a medium-sized bank? Are they held with another fintech? And then where do they hold their funds? and who's regulating them. So eventually it just comes down to decision.
So let's double down on workforce payment, right? The one thing and the mutual vision that we have, and honestly, the mission that we have with JP Morgan every single payroll cycle, is to assure that we hit the exact land date of the funds for the workers everywhere around the world. What type of tools do you have to help us to make it happen?
JP Morgan is investing a lot in APIs. I think we were one of the first adopters of API in our space. Those APIs are actually allowing companies like you to have the information within seconds. We invest in structures for account validation. We're investing in structures that allow for reconciliation. There are a lot of investment that the bank is doing. I think that what we also bring to the table is that closeness of having teams close to our clients that are able to mobilize the bank and also able to let the bank know what our clients would like us to invest further in.
So the future of payment is being, 24/7, and obviously kind of goes side by side with advanced technologies as blockchain. So maybe tell us a bit about how JP Morgan views that.
When it comes to JP Morgan, we've been investing in blockchain technology. So today we have a lot of fintechs working with us on the ability to move funds within the JP Morgan network 24/7. Creating that next level of disruption that needs to be done, getting our payroll faster and better.
So for us at Papaya, we chose JP Morgan on a very, very early days, although obviously kind of your compliance approach is a bit more challenging. There are definitely kind of barriers to market and barriers to work with us that are higher than just smaller banks and so on. Because we believe that for our type of clients, enterprise clients, working with tier one bankings, using your infrastructures, safeguarding their funds on tier one banks brings much more value. It's not, let's take the best technology, but eventually jeopardize the bank type that we are holding our funds, but it's really getting the best of all worlds. Mm-hmm. How do you see this roadmap of JP Morgan on the fintech side? Seems like you are very well committed to transform JP Morgan to be really a very large fintech kind of company.
Working with a large bank, and obviously I can only speak about my experience within JP Morgan, requires a lot of investment from companies. But that investment is a partnership, right? Whether it's AML, whether it's sanction risk, whether it's compliance in general, all of that is very important in order for this entire industry and for us in the industry to be able to support companies like Papaya. And obviously, continue to invest and build better products for you.
So often when we are trying to explain to our clients what is a corporate wallet, and a corporate wallet that is based on JP Morgan infrastructures, a lot of them ask us, do I need to have a bank account with JP Morgan? And I tell them, no, this is a wallet. Papaya is managing this wallet as a fintech company based on JP Morgan kind of infrastructures. So let's just kind of dive into that and try to explain the difference between having a wallet and having a JP Morgan bank account. What's the difference?
Okay, so first of all, this is a really good question because when we open a bank account, as you know, there is a long process, KYC, et cetera, et cetera. When we work with a fintech, which is regulated, such as Papaya, then actually you have your own license to allow you to hold and safeguard client funds. And you are doing that in a source of a wallet. Now, what is that wallet? Frankly, that wallet is maybe a ledger, right? That says Papaya owes you a not such and such money, and it owes me such and such amount. But eventually, what you're saying is, where are the funds actually held? And they could be held with JP Morgan. And we know that JP Morgan is a large bank with a robust balance sheet. And it could be held with another bank, which could be, a medium size, a small size, or a fintech. A wallet is actually the infrastructure or the technology that says that someone owes you money. This is your wallet held with the fintech. An account, obviously, very, very different. And where do we hold those funds? That's the balance sheet. On which balance sheet are they held? And what is the risk of that?
So to wrap up, if I'll take the infrastructures that a bank as JP Morgan built for over 150 years, right? And the technology across quite a lot of fintech kind of companies and sectors, those two forces together can determine the future of global workforce transactions, cross-border payments, really kind of accelerating things, keeping much better transactions and infrastructures and making the world a little bit more global, but also kind of allowing us to have much more confidence in eventually kind of the outcome.
I totally agree. Indeed, we should meet again next year and see where we are in real-time payments and blockchain technology and where workforce payments have, improved even further.
Thank you, Efrat. That's a date. Let's meet in a year time.
Thanks for having me.
And thank you for joining us. See you in the next lessons.